Good day, fellow investors. Today we're going to discuss 30 stocks traded on the Amsterdam Stock Exchange, as I analyzed all the stocks traded there, and in this specific video I want to discuss the 30 components of the AEX index, the Amsterdam Stock Exchange index. What I want to do is give a value investing perspective on the stocks there. Maybe you'll find something interesting for your portfolio, for your term strategic goals, wealth creation, but I also will look from my own wealth creation perspective, where we look for low risk, high reward, long-term compounders. I will also create a value investing risk and reward quadrant for all the components of the index to also show for those interested in investing in ETFs how are these indices structured and what's then the investing risk and reward. When it comes to my own quadrant, we have reward on the x-axis, so low reward, high reward in combination to risk on the y-axis, where here we have low risk and high rewards. Buys should be here and sells should be here. And you can check in the link in the description below, or if I remember here in the notes, the most recent update on my quadrant. So let's immediately start. There is a lot to do. The index has been increased from 25 to 30 positions. So I'll go one by one alphabetically, and then I think we'll all learn a lot about the investment opportunities there. When it comes to the rationale for the analysis, Warren Buffett always says start with the A's, go through a list, because there is so much knowledge that you're gaining that, and then that knowledge and research compounds over time. You never know when some piece of information, some nuance that you read on an investor presentation here or there might come in handy, I don't know, 5-10 years down the road. However, we also must be very careful here. Charlie Munger, in one of his speeches, said that he and Warren have no opinion on 98% of the business opportunities they look at. So 98% of situations you simply do not have an advantage. On 2% you can know what's going on, and then on those 2% you wait for the right entry price. Here are the 30 businesses. Personally, I am happy to look at 1,000 businesses to just find one that fits my criteria. The weights are not really correct because they have adjusted the constituents. I think in September increased the number of shares, and the last available I have found on the stock exchange was from June of this year. Nevertheless, let's immediately start. ABN AMRO, 4.69% yield, small weight. However, when you look at these financials, I'm not a bank, I'm not a financial specialist. When I look at all these companies, all of them have been bailed out by the government after the great financial crisis. So yes, the fundamentals look great here. P/E ratio of 10, dividend yield of 4.6%, great dividend yield, nothing wrong. However, also, going back to Charlie Munger, in a speech he discussed how these businesses go bankrupt on average every 50 years when we are talking about banks, and 30 years about insurance. When I look at the potential of loans in the Netherlands, how everything is leveraged, there you can get a 100% loan on your home, not even down payments are necessary. So that is all a signal of a very risky environment. So the key risk here is systemic, but nobody cares because if something happens, we will anyway be bailed out by the government. In the meantime, let's push it higher, get stock compensation, get the money, and then if shit hits the fan, you simply wait for the government to bail you out. So yes, the reward is maybe 5%, recessions, private equity, things like that the interconnections in the market are really crazy, and therefore I have put here, okay, I'm getting a 5% now, however, the risks are extremely high. And people will say, yes, now it's different, banks are capitalized differently. It's not just about banks, just about the value of money or whatever. The risks in the system are piling, which means this systemic situation is getting more dangerous, and perhaps, I hope, nothing happens and you keep on making your 5% yield with a few percentage points growth alongside economic growth. Nothing wrong with that. However, when the system breaks, you lose everything. The yield here is simply not worth the risks for retail investor. Adyen, it's a growth company, no dividend, good weight, 5% of the index payment system provider. However, it was growing extremely fast and now it has slowed down. When the company was growing very fast, the P ratio was 200. Now it has slowed down and it has a P ratio of only 42. Of course, a 45% growth rate might be great for, let's say, P ratio of 200, but we are now at a much lower level. The outlook is, let's say, that the anticipated acceleration will be unlikely, so even they are guiding for lower returns. However, total addressable market typically for a growth stock, and some people say when you see a total market slide, run away from that business. That also speaks of the risks. However, their stated revenue growth target is 20%. Here you can see 20% year over year. Now, can I project Adyen's 20% growth 5 years ahead? Can I then estimate a 10% growth rate going forward? No, because it's simply impossible. And if it works, yes, then the returns will be there. Let's say they grow 20% per year, they double in 3.6 years. So the P ratio will be 20. If they grow still, then the stock will be a plus 50%. And that is why I put it Adyen here at a 10 to 12% likely long-term return if they hit the risk rates, but at a very, very risky situation. So I don't know, the competition in the fintech environment is extreme. Everybody who's smart is going there. So I have no idea what will happen there. Therefore, for me, it is risky, albeit there is a return. Now, we've spoken about banks. We have here another insurance. The dividend yield is good there. I think my mortgage was there with Aegon when I lived in the Netherlands the last decade already. But I'm putting it here, 4, 5, 6% yields. And then that's about it, with ups and downs, recessions, things like that, plus the inevitable systemic risk that you run when you encounter that. Now, there have also been some comments about Ahold, which is actually not a European retailer, but first and foremost an American US retailer, because this company receives the biggest part of their revenues from the United States, the Lions, retails, and things like that. Anyway, the P ratio looks okay, 15, the dividend yield 3%. On top of that, you have to add the 1 billion in buybacks. That gives a total shareholder yield of around 6%. However, when I look at things, both the US, the Dutch retail markets look saturated, so you likely see the growth in line with inflation. If they can manage profitability a little bit, depending also on the macro tail or headwinds, then they will be okay. But if you look at the cash flows, 2.2 billion compared to the market cap of 32 billion is a good 6.8 free cash flow yield. Buybacks, 3% earnings growth, 2% inflation growth, and we get to the targeted mid-single digit earnings per share growth. However, when we look at the retail cycle, we are here peak maturity retail and then going into early contraction. A lot of retailers in the US have already been hit hard, and that is also a risk for Ahold. But also in that situation, I don't think they will cut the dividend, they will maybe cut the buybacks, but they should be able to weather it as they did in the past. So the dividend, 2% growth, long-term compounding, nothing wrong with Ahold, a good return, the best till now, of course. So you can, let's say, if you're happy with a 3.29 yield, retire on this if you have a few million, expect stability, maybe double down if it goes lower, which would make it interesting. I did own Ahold, I don't know, in the 20s, we sold in the 30s, but that is something different now. The factor when it comes to investing, a key factor is always price, and at this price it's simply not for me. Now, as I said, peak of everything, so maybe in these declines you can hold it. This was an accounting scandal, but they got out well out of that. So interesting, but perhaps not good enough for others. ExxonMobil, chemical, you can see here there are these businesses with not stellar but okay yields in the Netherlands, 10 billion market cap, smaller weight thus. And I'm looking at the business, and the chemicals have been hit hard recently. The outlook is flattish, the focus is on savings. They hope that they will still do okay, but when you look at the net income, it is pretty volatile. That's a normal situation for the company. On top of everything, I think they now acquired another company, an American, which might mean it is a smart acquisition because they are acquiring Axalta now, as already there is weakness in the chemicals, perhaps a little bit too early because the downturn has just started. All in all, that is there, so 5% free cash flow on acquisition, let's say it will pay for the interest on the debt, but let's say a 3-4% likely safer long-term return, but you have to weather the chemical cycle. The acquisition increases the risk because maybe it is about scaling, but the effect of that, positive effects, will take time and will be only seen in the long term. A very interesting business, ArcelorMittal, cyclical, steel, small dividend yield, small weight. However, the market cap is 30 billion, and you can see ArcelorMittal had its ups and downs. And when there is a recession, European recession or crisis, then the time is right to look at this. Now things look good, even if the extra profits from 2 years or 3 years ago have, let's say, subdued, but the company is still profitable. We are still above the 2010s extremely negative situation for commodity players. Then that led to huge profits in 2021, 2022. They have done some buybacks with that money. They are increasing, they are producing, making a mine also for iron ore, Liberia. So nothing wrong, the balance sheet is there, increased net debt a little bit. They got snapped on their fingers in the early 2010s on that, but they doing buybacks, nothing wrong, everything looks good now. So when things look good in the steel sector, it's not the time to look at this. If you want to buy it, you want to buy it when things look ugly and uglier. So if China slows down, prices might slow, so that might create there an opportunity. We are now at a 7% free cash flow yield. I always say with these commodities, you have to look at an average cycle, 20% free cash flow yield. So 7% makes it risky. If the price goes down of ArcelorMittal, then the stock will start going up here, all else equal, of course, on the quadrant, and might represent an opportunity, a cyclical opportunity, but not now. ISM International semis, small yield, of course, growth stock has exploded in the last few years. And even if they reach their targets from their Investor Day presentation by 2030, the free cash flow will hit a staggering 4%. So already the growth there and everything is already priced in. It's not my circle of competence. I hope it does well, but you are buying this at the peak of the AI semiconductor bubble. So that is risky, even if it can do really well. Let's say a 7% risky return long term across the cycles. ASML, we have discussed it a little bit. The weight is kept for all participants at 15%. So you have ups and downs in relation to mostly sentiment when it comes to the sector. So now we have had a boom, probably today even higher this week, as Nvidia reached good numbers. So the investments in the cycle are still there. Everything looks good. It's not as good as it looked just a while ago when the stock was closer to 600, and I told you that the likely minimum return is 50% with the possible double. In the longer term, the 50% have already been achieved from when the stock was trading at 600, but it's still a positive risk and reward, let's say. They're reiterating their guidance, slowly increasing China and going forward despite the hit there, but okay, orders, lumpy, things like that, we will see. But with the risk and reward long-term perspective, I have put it here at 7, less risky, better than most of the other buys that we have already mentioned. The thing is that in 5 to 10 years, it's unlikely the stock will be below 900. However, it can be much higher on the upside there. So still positive, not as good as it was. But when you look at all of this, everybody's buying now, everybody's investing like crazy. ASML is a part of that for the equipment, etc. So as long as this cycle continues, everything great. If the cycle reverses, then we might be back at 600, which makes it again an opportunity. ASR, Netherlands, insurance, we are looking at P ratio, dividend yield. All those insurers are priced equally. I'm just packing them down there. Another semiconductor stock, a smaller one, growing. They're into the packaging of things, small niche there. And they are, again, expecting this huge continuation in the AI boom demand. But even if they hit all their targets, that's a 3-4% likely long-term return. So lower return, higher risk, therefore. They're even more expensive than ASML. So practically likely go a lot of momentum trading there. CVC, private manager. Warren Buffett has cash that he has nowhere to deploy. These guys spend 50 billion, easier than you say, peanuts. So they have a dividend yield. Look at here, the fundraising, all investing, spending, they're getting a fee on that money. So they don't really care about the actual returns on that money. We are at peak private equity, private credit, private everything. So extremely risky. Again, that is on top of the systemic risk, we have another private risk hiding there that some people are mentioning, but I'm not going to risk losing everything in that crash that might come and might be the next, let's say, big short. So too risky for my preferences. DSM Firmenich, apart from the bad cycling team, again, good dividend yield there. Since the merger with Firmenich, the stock is down as that chemical situation is not looking great now, and we are not even close to a recession. It's just oversupply from China, from the supply chain shifting towards Europe as America's blocked with tariffs, things like that. So there is huge oversupply in the market, and they have their long-term targets, but always keep in mind these chemicals are cyclicals. And for now, it looks like fairly priced 3-4% dividend yield with a big, huge long-term chemical risk there across the cycle that hasn't really shown its teeth there yet. So on the quadrant, nothing special, the dividend, and that's it. Now, EXOR, we have recently made a video about EXOR, also Stellantis, race, discussing the discount there. If you fairly value Ferrari, not at 40p ratio, but at 20, which I think is okay, then you already lose 25% of gross net asset value. The other 25% is also practically worthless. They cannot sell it long term or when they will need to sell it. So that's already your discount, taxes, debt, whatever. And you see how EXOR is actually fairly valued compared to that other things. Okay. So EXOR, extremely risky. I also don't know how will they deliver, what advantage is there, so not for me. Heineken, nothing wrong with the business, but again, small dividend yield. They try to grow even if they have been flat, highly competitive environment. They have now started doing a little bit of buybacks on top of everything. So buybacks and everything, if there is a flat market, they'll reach that 4 or 5% long-term return, but also risky due to competition, the investments, they have to invest all across the globe to always try to be competitive. Another chemical, still low yield despite the decline there, and you can see the real prices, and we are still far from those real prices. These are serial acquirers, a lot of business groups, which also means no real advantage, and therefore just wait for the cycle. If it looks like it's going to be uglier, there is no upside in the outlooks, very risky, very low return, still, despite the historical high flying. Another bank, another good yield, big bank there, just put it there in the group of the 5% yielders with high systemic risks. INPost, this is a growth company, growth story from Poland, started there with the deliveries. Now they have started acquiring Menzies distribution and other players in France, UK. Therefore, they are still growing fast in Poland. But if we look at the profitability is Polish. The rest, they are entering huge competition with the other players there. So I don't know, I have no idea when the other players see that there is money to be made in Poland, will they perhaps take over this company, you made your money, and okay, but given the growth, I have no idea where would I put this into the quadrant. Will the management sell in 25 and go with the flow, take the money? Will it not? So very, very hard to assess. It's simply a bet on their growth, on executions, things like that. JDE Peet's taken over, as we discussed in this video, when it was deep value. Curing was fast on that. So, okay, now KPN, the stock has almost doubled in the last few years, and now the telco looks good, but 4.36% yield, there are 8% telco yields in Europe. When it looks good, it means that it is risky compared to other things. You can see here the telco boom. I hope that the current AI boom doesn't look like this. However, all the ingredients are there. The yield there, stable, going forward, just like that, like Ahold, like Heineken. That should be likely the return there. Another insurance, 5.9 return, okay, as they say, but I think there are the risks which I would not sleep well. Philips Healthcare, not my circle of competence, and this is another reason why I don't think it's EXOR's circle of competence, but they bought a huge stake in it. So healthcare, it is volatile. If they hit something new, they will do great, will grow. If not, if there are some issues like they had with the respiration things in the past, then it is risky. So I have put here a 6% likely return, but a risky one on the ups and downs. Prosus is less and less Tencent, more and more Prosus. They are acquiring things. developing that e-commerce, food delivery things in Latin America, Europe, things like that. Okay, but this is less Tencent. They are selling Tencent to buy those. I don't know. The discount is there to Tencent. I think the value per share is 80, but if you remove their purchases, we are at 60. So if you're buying Tencent, maybe there is optionality, but they just acquire Just Eat Takeaway, things like that. So to me, they are increasing the risk of something that should be as stable as Tencent. Randstad, I never understand this hiring companies because so cyclical, and apart from the dividend, I don't know. You can see here the huge growth in revenues, but pretty flattish growth in net income, which means that it is a very, very difficult environment, and these are the business models you don't want to get close at, as would Charlie Munger say. So very risky dividend yield there, likely declining. RELX, analytics to businesses, has enjoyed great growth over time. Now it's declining a little bit. They keep on doing their business. Perhaps a recession might slow them down, things like that. But the growth has been stellar, EBITDA margins, everything looks so great. However, how will AI impact them? I have no idea. I can't know, therefore also I can't put it on the quadrant. Shell. Okay, you're buying Shell again when everything looks good, then the weight in the index is the biggest, 14%. Everybody happy. The dividend yield just around 4%. But as you can see, you have the peaks and you have the downturns when nobody wants to touch this. When is the best time to look at oil companies? Of course, at the downturns. And you can see here, there is some resilience from the downstream that might also get impacted with electric vehicles and things like that. However, you can see here the upstream, the more volatility there, and that's exactly when you want to buy oil or look at oil exposures. Everybody is projecting huge growth by 2030. They will get 25 billion in cash flows from operations. All great. A lot of money, keeping the dividend buybacks. However, to me that's too risky. When things look ugly, we'll look again at oil companies. A very interesting situation with Bill Ackman, Universal Music Group. P ratio I've calculated around 16. So if they get listed in the US, that's a P ratio 30, and there you already have your 100%. You can pause here and read this from Ackman's letter. He knows the business well, the royalties on the music, he really likes that. The business has been growing for the last 5 years. If there is the expected slowdown in earnings per share, but for now we have not seen it. So all else equal, this is a 6, 7, 8% return on the growth, on the 2% dividend yield that's already there. If it continues, this is one of the perhaps best buys out there. It's of course always relative. I don't know how music works. Bill Ackman seems to have dug his teeth into it. So read this if you are interested. I've looked a little bit at the presentation, things like that, but simply not my circle of competence, even if it looks good, and I'm not going to make it a circle of competence. Unilever, they have sold the bad assets, they are improving then the margins, everything looks better, and the analysts from Wall Street are happy, but the dividend yield there is just 3%. For me, it's very risky from that perspective because you never know what will happen there. The long-term trajectory of brands globally is not that positive, high competition. Warehouses, the Pauw, 3%, almost 4% yield. There is still invested from that 6 to 7% free cash flow that these, let's say, European REITs have. Some REITs, you can check more on the Amsterdam Stock Exchange, offer a 6-7% yield, which is starting to get interesting if you are into those things. If they keep on growing, that should be a good return there. Perhaps not the stock going up as the 3% becomes a 6% yield. However, nothing wrong with it. It looks okay if they keep on growing. So I have put it here at, let's say, a 6% yield for the long term among the better players in the sector. Wolters Kluwer, small yield. People are likely getting scared from the AI. Stock has been declining. I have no idea, not my circle of competence. Now, when it comes to the conclusion, this is due to valuations. I'm having here on average a 5% long-term return with recession, systemic risks, valuation risks, bubble risks. 5%, not bad, but also not stellar. This is what you get when you invest in an index. So now we are at great times. If you have to invest in indexes, then be sure to invest constantly. Okay, invest your monthly, but make sure to invest where you lose your job here due to AI and things like that. And that is where you accumulate most of the wealth. Now, likely long-term 5% return, perhaps even lower as it has been over time. You can see it's 2-3% per year, not stellar. Perhaps the dividends add something there, but 5% going forward. Just to give you an example of why I consider the above risky, this is a stock that we discussed in a video. I'll put the link in the description below. 10% yield, 5% growth, Norway, plus the taxes there, so a little bit lower. But I think you can do 6-7% after taxes. There is also taxes on this, so still there. And the growth likely going to give you a 10% return. So I would put EXOR, let's say, somewhere here. So if you can find 10-20 businesses like that, I think it's much better than this situation here. So I hope you enjoyed my AEX overview. You see how something might fit. I didn't find anything that might fit me. ArcelorMittal and those things are in my cyclical watch segments scenarios. When those crash, continue to crash, or there is a recession, we'll take a look and then see whether that or something better out there. Thanks for watching. I hope you enjoyed this, and I'll see you in the next video.